taking a comprehensive look at everything to say, okay, these are some gaps. These are some areas that we may need to shore up and close up so that we can be on to
the next level.
Yep.
Yeah.
If our goals are, I want to pay for my kids' schooling, or if I want to pay off my mortgage early, or if I want to retire early, whatever that looks like, put yourself by getting that foundation of your home in order. It is going to put you in a position of power that allows you to scale up and scale out.
That's awesome. That is absolutely awesome. I'm going to ask you another question. What would be, or in your opinion, the reasons? I think you covered one, age. Are there any other reasons why an insurance company would refuse insurance to an individual or refuse a payout, which is even more important?
Well, okay, so let's start out on that. Refuse a payout. Okay, so most insurance policies have a 2-year contestability period, okay? So if they were to find something in that 2-year contestability period to where you were not being truthful and you did not disclose something, or willfully omitted something and something transpired as a result, they could look at that and they could say, hey, you know, due to this person not being forthcoming and getting, trying to get coverage under false pretenses, that could be something that's looked at. It could be researched, but it doesn't mean that they'll automatically deny that payout. If you are doing something illegal,
Sure.
if you're caught in,
So it's fraud.
right. So, right. Well, and not even, no, if you are, if you are caught up bank robbing and
so if you commit a crime.
if you're committing a crime and you die while committing that crime, the insurance company is saying, hey, we're not going to be paying out for felonious activities that you went
So
out.
someone goes out and gets in a gunfight because they're trying to, or does something risky. The insurance company will go, no, you died, but you tried to rob the bank and got killed in the process.
Right.
They're not paying out.
Right. So something like that. Yes. If you're doing criminal activity, yes, that will be the time that they would not pay out. If you died in the middle of a police shootout. Like, no, they're
Really?
they're probably going to look long and hard before they were to pay something like that out.
What if someone takes, or God forbid, takes their own life?
That happens, and it happens, and if they are past that 2-year contestability period, yeah.
So when you say the 2-year contestability, so someone passes away, do that you have to wait 2 years before?
No. So,
Okay.
no.
Okay. So they pay out anyway, but then they're leaving a 2-year open period.
Right.
For any contest.
Right. So if if something happened, and like if an accident happens and it hasn't been 2 years, that's life.
Sure.
So, it's meant to pay out for accidental things. And so it's going to do that. But with regards to, like I said, if they found out something was not true, based on what they gave, the insurance company just gives you a 2-year period. If something is found out within that 2-year period, they could terminate that coverage that they've given you, whether you're expired or not. Just saying that's what that 2-year contestability period. If something comes into the fold to where we misrepresented ourselves and the insurance carrier finds out, they can cancel that contract. That would be the only time that they could really cancel the contract.
Okay.
Outside of non-payment.
Oh, I understand. So what about if somebody withheld, say, a medical condition and then they passed away?
Well,
what would happen? Would the insurance company still pay out, or would they withhold payment?
Okay, so typically, when it comes to that, if you're insured, they already did their vetting process.
Okay.
You've already went through underwriting. Now, if something came about afterwards, that's just, again, that's what insurance is for. It's accidental. That's life. It happens. But typically, they will have done all their pre-vetting before. Now, there are times to where if it's less than that 2-year period, it could cause them to look into some things, and they would have to ensure that they did, good on their side.
Because I've got several insurances, and I think a couple of them just have done it on the phone. They've not come and did all the other bits. So some have and some haven't.
Right.
So whatever I've told them on the phone, I don't know if they've done back. I've told the truth. Of course.
Right. They're not just taking you at face value. A lot of times they're still getting, because we have your social, like you.
Okay, there's
You
back
give
there, yeah,
right.
sure.
So
There's
they're
information.
doing. That's a part of the underwriting process. And let me tell you, even criminal history is something that they're looking at. Like, so they look through various things. If you're
So they have powerful databases.
they have a database to where, hey, we could see, like, if you have a long medical history of prescription drugs, like, they can see, and
That's risk.
that's risk. And so sometimes they may ask for medical records, they may ask for fluids, because they're trying to do a full evaluation to understand, okay, is this a good risk, is this a risk to where this person is 25 and they'll have a long life, or is this a 25-year-old that is
Living a fast life.
living a fast life and is not somebody necessarily that we want to insure? So it's all about risk, a smart risk versus not so smart risk. Exactly.
That makes perfect sense. So, and insurance houses, they're obviously very good at what they do.
Mhm.
And I say that is because they're some of the richest institutions in our society.
Yes.
They're pretty much richer than banks, aren't they?
Some of them are.
Yeah.
And, the AAA rated institution that I'm affiliated with, they've been around for a very, very long time. And that does, give, that puts people at ease.
Yes.
We're not a fly by night institution.
They're going to be around.
Right. And you just want to make sure that whomever that you affiliate with these carriers, that the promises that they make on paper, they're going to be able to deliver on them, and they have a track record of that. So, sometimes they are richer than banks, or they have, again, the AAA rating means, hey, I have enough in excess. I have enough in reserves. Sometimes we see AAA title in the name. They may be like, I'm AAA insurance. That may be the name of the company. But no, to actually have a triple A financial rating, it speaks to your financial strength.
Wow, that is powerful. So you're saying insurance companies that we go for, we should look at their rating.
Yeah.
Because not every insurance company has AAA. And
Right.
you're saying AAA is about the excess finances they have
Correct.
to pay out in the event.
It just means that, hey, to be AAA, I want to say you have to have $17 billion in reserves. And so,
Above and beyond what you're supposed to pay out.
right.
Wow.
And so it just means that, hey, if they paid out all their claims, they're still going to have this
17 billion.
excess.
Oh, they got money.
So it just means that, yes, they're in a position of power.
They're not hard up for money.
Right. They're not a fly by night. They strategically over, the past century, they've been able to get it right.
That is powerful.
It is.
So analyze who that insurance company is, have a look at that, and analyze what it is. Because when you get an insurance contract, there's a lot of small print, isn't that sometimes people don't look at. I had somebody that I knew at my church in London who had a heart attack, unfortunately. And when they had it, I went to visit them in the hospital. There's a member of my church, and they said, well, at least the mortgage is paid off, because, there's something in my insurance that says if I have a heart attack, they pay the insurance. And then several weeks later, it was a certain type of heart attack.
Oh, okay.
So
It can be very granular.
Yeah, it had to be a certain type. And
Interesting.
I was like, it's a bit
Right.
technical.
That is very technical.
Yeah.
No. Now, I didn't know that it could get very granular like that, but I know in certain cases where if you have like a terminal illness,
Sure.
with
There's a payout.
18, 12 months to live, like they will liquidate your policy and yes, give you access to the death benefit earlier. So what happens
So you
is
pay the cost, but no underwriting.
your health, right? You keep your same health rating, but your age. So that if that shifted by 5 years, 6 years, well, that new age, depending on how much coverage it is that you are, breaking off that you
The
want.
premiums really upset.
Okay.
So universal.
So universal life is, and then lastly, we'll do permanent whole life. Universal life. Universal life is pretty much a combination of a term type of coverage and a permanent cash value. Um, type of coverage. Okay. It typically has a flexible premium. So, a couple of big nuances. Now, the cost of universal life coverage is typically you get more death benefit with your premium dollars than a permanent whole life. Okay. So, you typically can get more death benefit.
On a universal.
Yes, with a more cost effective price point. Okay. So, it's a little bit more flexible, but how universal life works is if I had to liken it to something, it's like, say we have a bucket, and every month in that bucket, now with this bucket, uh, the things in this bucket can last as long as we need it to, but we have to make sure that the ingredients that we're pouring into the bucket is gonna allow the bucket to go for as long, and that bucket isn't gonna run dry. So the best ways to explain it. With universal life, you purchase a death benefit, okay? Every month you're paying a premium. Now, with universal life, it's flexible. They say, hey, you can pay the less premium, or you can fund it with a little bit more higher cash value. So every month you are paying a premium.
And a cash value.
So every month you're paying a premium that goes into this policy, and then you are getting you're getting a credit. You're being credited. You're getting credits. Universal Life has an interest rate that it gets credited on a monthly basis. Okay, so if you're putting in a premium and they're giving you interest
5%.
or 3.5%, okay,
It's more
because
realistic. Okay.
that's more realistic. Okay, now mind you, over the life of these plans, that interest rate that they're crediting that policy, it could go down. So they may start at 3.5, but if interest rates fall over the life of that plan, what is going to happen, because again you have a premium going in there, you have interest being credited in there on a monthly basis, but with universal life you have expenses that come out on a monthly basis, you have mortality expenses that come out on a monthly basis with universal life. Okay, you have costs of insurance fees that come out of universal life. And so although it could be one of the more flexible cash value life insurance plans. The way that cash value works is a little bit different than a whole life, because over the life of you, what happens is that the hole in that bucket could become larger. Why? Because the cost to insure us rose as we get closer on that mortality table to age 100. So the fees that you pay as a young person, a 20-year-old, 21-year-old, they're going to be pennies on the dollar. Whereas later on in life, if I have not increased what I'm doing as far as a premium payment, say interest rates have fallen, okay? So that means that this policy really has to grow by the premiums that I'm putting into here. And again,
So I have to increase the premiums.
you typically need to increase what you are giving later on in life if you fund it on the minimum side when you're young. Okay. So again, you could get these policies to last as long as you need them to, but you have to fund them with enough cash value, because again, right now the premium is low, but what'll happen is the fees on the back end over the life of this policy will start to eat that cash value.
And the interest rate is determined by the Fed, so it goes with the Fed's interest rate.
Right, right.
Okay.
And again, that can vary. Actually, it's not the Fed's interest rate. It's a different It is
Based,
based off. It is based off of that.
but they create their own.
Right. And it can change. It can change. So again, what it starts at 3.5, they may say, hey, it can't go below 2%. Okay, in the fine lines of that
And how
contract.
much percent are these fees taking? Because they could be taking all my, if I'm not careful, all my interest.
And it can. And so again, with those types of plans, if they are not funded properly, depending on how long you want to keep this, well, if you want to keep this for a lifetime, it's going to make sense to fund it with more cash value in the early years, so it has more in the bucket. So going into the latter years, when those fees start to rake up, well, I have enough cash value in that bucket to where to where it's gonna last me a long time. I'm gonna have more longevity.
And I can't loan against this universal, and I don't get payouts
You
loaned away.
So with Universal Life, it's a cash value life insurance plan.
Okay.
So you can borrow from it. You can borrow from Universal Life. You can. But it but when you borrow from it, it works a little bit differently because again, you have interest that gets credited to this policy. And so if interest rates fall or anything, those things can impact the policy's cash value. So, if borrowing, you can borrow from it, to answer
Okay,
your question.
you can borrow, and it's paid back through death.
So it's paid back through death, or you can pay it back over the life of you.
Okay.
Okay.
Wow.
You could pay it back over the life of you.
Wow. Okay, and so just to be correct, so universal lasts for how long? The whole of life, or is there an expiry date on the insurance?
So, depending on how that plan is created, it could have a benefit all the way until 121. It could endow at 121. You just have to fund the policy in a way that is for the long haul, for longevity. Because again, right now, when you're young, you have some leniency. So, some people may they may get into a pattern to where they're paying less, okay, and they may get into a pattern to where they're paying the lease for years,
And then it catches up.
and then it catches up on the back end because now you've underfunded this policy for so long. Now you have to infuse this thing with cash value so that this policy can stay in force, because you need cash value in this plan.
And talk to me about whole life.
Okay.
I
So whole life.
think we need another episode, but let's go.
So whole life works a lot differently. When we talk about life insurance, that's whole life. When we talk about life insurance, an insurance plan to life, okay? People kind of mix it.
You say that again. Sorry, I'm
Whole life is an insurance plan to life.
Okay.
Pretty much.
Sure.
So when we talk about life insurance, well, whole life is insurance that you have throughout your whole life.
Sure.
Not just a death benefit. I get living benefits from this. So just like any other insurance, I pay my premium. The insurance company is going to pay it out. Okay. So with permanent insurance, with whole life insurance, it is dynamic. So whatever death benefit that you lock into, it won't stay at that. It typically can grow over the life of you without you having to increase your premium.
How is it growing? Through the interest rate?
No. So, for example, with the company that I work with, whole life is built on certain guarantees. And so the guarantees are, we're going to lock in your insurability. We're going to freeze you at the cost that you lock in.
Yep.
Okay? And that's the premium cost that you'll always pay. How does it grow in value? It's not through interest, but the guarantees of whole life is the cash value and the death benefit are supposed to equal the same amount by age 100.
Okay.
So, for example, if I buy $100,000 death benefit, okay, over the
And cash value. Or the thing with death
Well,
benefit.
cash value is something that grows
Sure.
over time, okay? So it's the equity that starts to grow from having this asset over time, okay? It takes some time to grow it out. Depending on what you do with whole life, you could do a traditional route or you could do a custom whole life.
So whole life is an asset.
Whole life is an asset. Whole life is
Wow.
whole life is an asset, okay? So when we think about
So the cash benefit is being generated from the asset, which is I'm insured for life, and therefore that asset is creating a cash value.
right, the premium that I'm paying, it's going to create a savings reserve if I continue to pay into this 10 years, 20 years. And with some companies, you can get some additional growth in that cash value if you're, partnered alongside a AAA rated company that, for example, the company that I work with, they are a mutual company. As a mutual company, they are privately held. Okay, so they're not publicly held companies. They're not
Privately.
privately held. So they're not beholden to shareholders, the stock market, the things that are impacting us right now. And so, with that being said, as a mutual company, policyholders, when we have a surplus or excess, we pay out dividends. Those dividends have the ability to grow your policy's death benefit. It have the ability to grow the equity in your policy.
Let me ask you this question. What age do you believe an individual should take out life insurance? Because um, typically people get sort of around 40, usually, and then they think about it, some in their 30s, but 40. But when do you think it's most important? Because you mentioned it being an asset.
Mhm.
And my knowledge always tells me when you're dealing with an asset, the length of there's certain factors, predominantly three factors in getting the most out of an asset.
Mhm.
One is time, one
Mhm.
is obviously money, and another is interest rate.
Mhm.
So, my without knowing as that much about life insurance,
Mhm.
but it just tells me when I look at an asset, the longer you do it,
Mhm.
is the more exponential that asset grows.
Right. I mean, yeah, this is what I like to liken it to. You asked in a previous episode, should somebody have their life insurance running in tandem with their investments? So to kind of draw on that point, the can you bring me back to the point?
The point I was saying was, what age should a person?
Your youngest and healthiest age,
Okay,
okay? Being that it's on a mortality table, your youngest and healthiest age, okay? And so to liken it to investing, if you're investing, you're not investing with the chance that you're going to be able to pull the funds tomorrow.
sure,
It takes time.
to build
And
up the cash benefit.
and so the same thing would be said for this. So the younger and earlier that you start, well, there's a great chance that I'll be able to use it sooner because I've spent the time growing it out. Like you mentioned, the time, the money that I'm putting into it, and the interest that it's earning. And so if I give myself, if my time horizon, if I have a 20, 30 year, well, that's a longer time to grow something out. So if I'm 20, then and I want to be able to use something and I'm 40, well, it would behoove me to do it at my youngest and healthiest self. Why? Because that is when it's going to be the cheapest and the most cost effective. It typically, your health and again a premium for a 21-year-old as opposed to a 41-year-old is going to be different because we got a 20-year age difference.
So if someone at 20 says, okay, I want to take out a whole life
Mhm.
cash value insurance, the premiums throughout their whole life would be the set amount and it
Mhm.
would be much cheaper.
Yeah,
Ah.
it is. It is, but
So a 40-year-old would pay, let's say, $50. We're just using examples
Mhm.
here. And a 20-year-old, would they pay half or would they pay less than half?
They may pay less than half. They may
Yeah.
pay less than half because somebody's personal health. You can have a rating all the way from select preferred being the best to a non-smoker or a smoker, or you could be sub-rated after that. And so
But assuming both are healthy
mhm,
at 40 and 20, what would you expect the premiums to be for the 20
it's
of it?
gonna be
Half of the 40 or less than half?
half probably.
Okay.
Probably have.
Oh.
And not to say that because you can be in great health at 41. But again, the cost of insurance for a 21-year-old, just going off of the cost of insurance, it's going to be cheaper, much cheaper to insure a 21-year-old because they're much further away on the mortality table than somebody that's 41.
And then the 20-year-old will get the cash benefit much earlier in life.
They will, but Imma tell you this, because it's all measured on that mortality table, so the cash value, rate of return for somebody that is 41 is gonna work out differently because 41 to 59. So, the insurance company, the face amount and that cash value are gonna equal the same at age 100. Okay. So that's a 59 year period to recoup that. Whereas with a 21-year-old, it's a 79-year period to recoup that. So that means that that cash value is going to grow a little bit slower. Why? Because the insurance company has much more time to recoup that.
Ah, I understand.
Okay.
So the rate of return will be less.
It will because they're younger and they have many more years on the mortality table to but so
I
but
understand.
it's still gonna grow at a value that's in tandem because again with whole life that the whole North Star is that by the time this person is 100, if they have $1 million whole life, then the cash value is gonna equal that when they're age 100.
Wow. Do you deal with health insurance?
No, not necessarily, health insurance, but, no, I don't. I
Okay.
really in the scope of what I do now, there are some agents that have a practice where maybe, they do some of the Medicare supplements and things like that, but no, really what it is that I do is more so,
With
uh,
life insurance.
life and disability insurance or long-term care insurance, things of that nature.
Can you talk to me about disability and long-term care insurance?
Okay. So disability insurance is really more so individual disability insurance. It's a portable protection. Maybe your job has short term disability. Okay. And maybe it'll cover you through a period of 6 months.
Ah,
And they'll give you two-thirds of your income, but it's going to be taxed. Whereas you can create something portable, like how a basketball player or anybody, any skilled professional, you want to protect your income earning ability. If I make $300,000 a year as an attorney, I want to protect that because
so this is disability insurance now.
it's
Okay.
disability. So disability insurance protects my income earning ability. So if I'm
Oh,
if
so that's my income earning.
right, so if I'm covering a portion of my income.
Sure.
So with that, you can create a plan that says, hey, if something happened to me, I'll basically I'll protect my I'll protect my income. If I need $5,000, if I need $7,000 because I have a mortgage payment, the children, it will ensure a tax-free payout for a length of time. 2 years is the typical period,
Okay.
but you can create them to where, um, you know, if I never recover, then this can be something that's ongoing.
Wow.
This can cover me for a period of 2 years, for 5 years, up to 65, up to 67. So this is something where it's an individual disability protection that you put on your income earning ability, and it will basically, if I'm injured, if I can't do my work 6 months or more, then something what happens is this pays out for a tax-free period of time for that 2 years. And if after that 2 year period, depending on what type of plan that I've customized, if I'm a plastic surgeon, maybe I have some disability coverage that's solely for this occupation.
Sure.
And if I'm never in a capacity to where I can return to this, well, you can have some disability protection in place that, covers you all the way to retirement age. Again, it's just paycheck protection in the event that, again, I'm young, I'm not able bodied, but I still have the bills, I still have retirement planning that I'm doing, I'm still paying off a mortgage. So it's just protecting a portion of your paycheck.
Okay, so it's a portion.
Hmm.
So if my company is paying me 50% of my paycheck, then disability insurance will pay the other 50.
You can get it to supplement. So you can design it because this is
Or can I get the 50 from my job and 100% from the disability
you
insurance?
could because if your job is doing some short term, well, that short term is probably only guaranteed for a certain amount to where, maybe 6 to 9 months. And what if, your event lasts longer than that? Well, that's when your disability insurance would be kicking in and it's portable, outside of your workplace. So, however you have fashioned it, maybe you fashion it to be something supplemental because you have something at work and you just wanted to kind of gap up what you didn't. But maybe you don't have anything at work. And so, through this individual disability insurance, you're saying, hey, I want to make sure that $5,000, $7,000 of my income is protected on a monthly basis. And so you could design it that way. If you don't have anything, if they don't, protect you in that way at work. And a lot of times, we may not learn about the nuances of these things until we actually have to use them. And
Sure.
then we're at a disadvantage because now it's too late to do anything else.
Wow. So that's disability.
Mhm.
And the other one was
Long-term care coverage. Long-term care coverage really talks to if we have some extended care event to where maybe I can't do two of the activities, the six daily activities of living. If something comes into play, whether I'm old age or whether I'm young, and it requires the aid of skilled nurses, or I have to be in some type of rehabilitation facility, or say,
stroke or something.
or yeah, or say I'm old age and now I need to be in a home of sorts. Um, Putting long-term care plans, whether we're talking about the traditional, where it's simply for in-facility type of care, or there are plans to where they're hybrid, to where they could provide some assistance for long-term care needs, or it's hybrid in the sense that it could be life insurance too. It could pay out a death benefit if it's not used for long-term care needs. So I do work with educating people on the plans that are traditional long-term care coverage, and then hybrid, the ones that are not just long-term care, but can also provide a death benefit or give you a premium back in the event that you don't utilize it for a death
Okay, so
benefit.
it gives you a premium back.
Those are the non-traditional long-term care plans, the ones that can be used for multiple things pretty much. And if you don't use it, if you never have a long-term care need, it could be a it could be a death benefit for a loved one, or in some instances you can get your premium back.
Wow, this is so powerful. Listen, we are talking about life and legacy, and we're really outlining some of the steps that we need to deal with as believers, and even those who don't, because the Bible says it that we must leave an inheritance. So it's important. Again, we've been discussing life and legacy and how we must live a life as an example, but we should leave a legacy, which is important. God said to Abraham that your seeds will be like the stars in the sky and like the sand on the seashore. So he left the legacy that we're still speaking about today. And most of the characters in the Bible, positive ones, left a good legacy. And that's what we're called to do. I want to invite you to our service, 10:30 a.m. on Sundays, CLCC. The information is on the screen. And come along, bring somebody with you, be blessed, uplifted, encouraged, and motivated so you can move to the next level. Father, we thank you today. We give you the honor, the glory, and praise. Thank you for everyone that has joined us by way of online. And I pray you bless them, that they would live a life of legacy and that they would make impact in all that they do. In Jesus' name, Amen. God bless you, and we'll see you soon. Thank you, Andrea.
Eh,
Bless you.
My pleasure.